Hello friends, in continuation to our last discussion related to blocked credits, we completed our discussion up to motor vehicles and construction related services, and now we are proceeding into other blocked credits. If there is any inward supply of membership of a club, health and fitness center, that is, generally in the course or furtherance of business, we take memberships of certain clubs, and for that we will be paying GST. Say professional clubs, and that GST cannot be taken as ITC. Even on the health of the employees, some health clubs are there, or this fitness center memberships are there. So these are all cannot be taken as ITC. GST bid cannot be taken as ITC. However, there is an exception. That exception is if the said expenditure is incurred by employer to employee. For that, suppose if statutorily it is required to be incurred by employer to employee, and if that membership has been taken, then ITC is available. Then travel benefits extended to employees on vacation. So here this travel benefits extended to whom? Only to employees, that too on vacation. What if it is to other than employees? Other than employees means other people like creditors or debtors. Why for debtor? Maybe for clients, or maybe to the statutory auditors. If travel benefits are given, vacation only, they are not employees, nah? And in that case, whether ITC is available? Yes, because here it is given as only employees, that too on vacation. What if it is to employees for business purpose? Then ITC is available. Then we have an exception here. Suppose if it is provided by employer to employee under a statutory obligation, then ITC is available. Yes. For example, if it is mandatorily under any law that they need to incur the travel benefit to the employee, and if they incur, then ITC is available. Then inward supplies of a non-resident taxable person. Who is a non-resident taxable person? A person who is not having any physical place of business in India but enters into India for making any supply of goods or services occasionally is known as non-resident taxable person. So a person who comes to India, is he having any physical place of business in India? No. So he comes on an occasional basis for making some outward supply of goods or services. So that person is known as non-resident taxable person, and every non-resident taxable person is compulsorily required to get registered. So generally these mobile smartphone manufacturers are there, right? In Korea people. So they will be coming to India in order to sell their mobile phones, smartphones in India. So these people will come into the category of NRTP, and they are compulsorily required to get registered at least 5 days before commencement of their business, and they cannot take any ITC with respect to their inward supplies. I told you that reason, like why they need to compulsory registered, because you should not be under an impression that because they are unregistered, so they cannot take ITC. It is not that way. They are registered. Even when they are registered, they cannot take ITC because it is blocked credit, and only with respect to one inward supply they can take ITC. What is that? If they import any goods. If they import any goods, with respect to that import of goods only, they can take ITC. Then next, food and beverages, outdoor catering. So related to food, you just remember food and beverages, outdoor catering, one statement. Then next statement, beauty treatment including cosmetic, plastic and hair transplantation. So all these are connected to beauty treatment. First is connected to food, that is food, beverages, outdoor catering. Second point is connected to beauty treatment like cosmetic surgery, plastic surgery, even hair transplantation, everything will come under beauty treatment. Then third, life insurance and health insurance. So 3 points you need to remember: related to food, related to beauty, and related to the insurance. Related to food and beverages, outdoor catering. Related to beauty treatment, cosmetic surgery, plastic surgery, hair transplantation. And third, life insurance and health insurance services. This inward supply ITC is not available, but we have 3 exceptions here. What are those 3 exceptions? If inward supply and outward supply is in the same category, for example, I am an outdoor caterer and I receive outdoor catering services, I can take ITC. I am an outdoor caterer and I receive outdoor catering services, I can take ITC. Then I am engaged in the business of supply of food, I purchase some food, I can take ITC with respect to that food. So if my inward supply and outward supply are same, that is the first exception here. Then if inward supply is part of composite or mixed outward supply, what is that? That is, I am into the business of transportation of passengers by air and I am transporting passengers by airways and I receive outdoor catering service. So this outdoor catering service, whatever I receive, is a part of my composite or mixed outward supply. Therefore, I can take ITC with respect to the inward supply. Then third exception, if it is provided by employer to employee under a statutory obligation. So this point is there already, we have discussed as exception for the other cases also. Then from a person opting for composition scheme, there is a person who is opting for composition scheme. From that person, if there is a person who is opting for composition scheme, from that person you purchase any goods or receive services and GST is paid. First of all, GST is not paid, should not be paid, they cannot recover. Suppose if they recover and you have paid, then you cannot take it as ITC. Then if you have purchased any goods or services and you have used it for personal consumption, then also you cannot take ITC, because it is not used in the course or furtherance of business. Then goods lost or stolen or destroyed or written off. Goods are purchased, they were stolen, lost, destroyed, written off. What reason? Any reason, natural reason or abnormal reason, whatever it may be, or disposed by way of gift or free sample. I purchase some goods which I am giving as gift or free sample, then also I cannot take ITC. So this is with respect to goods lost or stolen or destroyed or disposed of by way of gift or free sample. There is one more exception. Hiring, leasing and renting of motor vehicles we discussed. Hiring, renting and leasing of motor vehicles. If motor vehicle is eligible for ITC, you can take credit with respect to that. Even there are two more exceptions with respect to hiring, renting and leasing of motor vehicles. There are two more exceptions with respect to hiring, renting or leasing of motor vehicles. What are those two exceptions? Let's try to understand that. Exception, already we have seen one exception. What is that? If that motor vehicle is eligible for ITC, then with respect to that services also we can take ITC. That is one exception. Now second exception here, that is, if that is incurred as a statutory obligation. Incurred as a statutory obligation by employer to employee. So with respect to inward supplies, that is hiring, leasing and renting of motor vehicles, we have one exception. What is that? If that motor vehicle is eligible for ITC, we can take ITC with respect to that services. Second exception is, if it is incurred as a statutory obligation by employer to employee, then also we can take ITC. So this is about blocked credits here. So we completed 17 subsection 5 blocked credits. Now we are moving on to other areas in 17 subsection 1, subsection 2, subsection 3. Look into page number 32. That is apportionment of credit. That's the next area. What is this apportionment of credit? Simple here. If I am using some inward supplies only for my business purpose, can I take ITC? Yes. What if I am using for a non-business purpose? I cannot take ITC. Just now we discussed personal consumption, we cannot take ITC. What if that inward supply is used both for business purpose and non-business purpose? Proportionately, I can take ITC. So that's what 17 subsection 1 says. Goods and or services used partly for business and partly for non-business. ITC available only as is attributable to business purpose. Same way, if some inward supplies are exclusively used for exempted supply, can I take ITC? No, because I am not paying any GST on exempted supply, so I cannot take ITC on inward supply. Suppose if I am using for taxable supply, my outward supply is taxable. Can I take ITC on my inward supply? Yes. What if the inward supply is used for both taxable supply and exempted supply? Can I take ITC? Yes, with respect to proportionate. That's what given. Goods under or services used partly for making taxable and partly for exempted. ITC available only as is attributable to taxable supply. Now, zero rated supply should also be treated as taxable supply for the purpose of availment of ITC. Even though when my outward supply is zero rated. What are zero rated supplies here? Exports and supply to SEZ is zero rated supply. Even though my outward supply is zero rated, but I can take ITC on my inward supply. So therefore, zero rated supplies are classified as taxable supply for the purpose of availment of ITC. Then, that's what I have given as a note. Zero rated supplies will be covered in taxable supplies for the purpose of availment of ITC. Then, what are exempted supplies? In this discussion, we have made one point. What is that? If we have any inward supplies which are exclusively used for exempted supplies or partly for taxable and exempted supplies, to that extent which is used in exempted supplies, ITC is not available. So what is the meaning of exempted supplies? That is given in 17 subsection 3. What is the meaning of exempted supplies is given in 17 subsection 3, which says the normal meaning. First, what is that? Generally we discussed exempted supplies means what? Notified as exempted, nil rated, non-taxable. These three are exempted supplies in general. Apart from these three, we have some more exempted supplies also. What are they? Supplies covered under RCM. Listen carefully. I am making some supply which is covered under RCM. So my outward supply is covered under RCM. I will not pay GST. Then who will pay GST? My recipient will pay GST. For me, it is exempted supply, which means when I make some inward supply, can I take ITC? No, I cannot take ITC. Again, I am repeating. I am a supplier who is making supplies covered under RCM. On this, who is liable to pay GST? My recipient is liable to pay GST. So for me, it is exempted supply. Now, I am making some inward supplies on which can the GST paid be taken as credit? No, I cannot take it as credit because supply which is covered under RCM is actually a taxable supply. But it is taxable in the hands of recipient. But it should be treated as a exempted supply in my hands. Therefore, I cannot take ITC on my inward supply. This is that fourth point here. Then, sale of land. Sale of land is not at all a supply, but it should be treated as exempted supply. What is the disadvantage of this? The disadvantage is that if it is treated as exempted supply and if it is treated as exempted supply, I have to take the proportionate now with respect to both taxable and exempted means I need to take proportionate. So that proportionate will come down because when a huge amount is kept under exempted, my credit availability will come down. Because not every credit, not every inward supply can be identifiable exactly for taxable outward supply or exempted outward supply. There are some common inward supply which cannot be identified with respect to taxable outward supply or exempted outward supply. This common credit, we need to take a proportionate common credit. But when a big amount called as sale of land is included in exempted supply, so my availability with respect to the common credit will come down. Same way, sale of building is not a supply, excluded from supply, but should be treated as exempted supply. When your sale of building should be treated as exempted supply, when sale of building is excluded from supply. Sale of building where entire consideration is received after obtaining completion certificate or first occupation, whichever is earlier. Then that is point number 5. Then point number 6, 5 and 6, sale of land and sale of building. In case of land, what should be taken as the value? The value should be taken as the stamp duty value here. And last point, point number 7, sale of securities. Securities, neither goods nor services. But if there is any sale of securities, that should be treated as exempted supply. How much should be taken as the value of that exempted supply? 1% of the sale value should be taken as the exempted supply. 1% of the sale value should be treated as exempted supply. So tell me what are the 7 exempted supplies. Number 1, notified as exempted. Number 2, nil rated. Number 3, non-taxable. Number 4, supply covered under RCM. Number 5, sale of land. Number 6, sale of building. Number 7, sale of securities. And for securities, what should be taken as the value? The value should be 1% of the sale value should be taken as value, and that should be added to the exempted supply. Now, we have one more point related to exempted supply. The following 2 points are exempted supply. There are 2 exempted supplies. Really, they are exempted for payment of GST. But for availment of ITC, it should be treated as taxable supply. For payment of GST, it is exempted supply. But for availment of ITC, it should be treated as taxable supply. And what are they? Services by way of accepting deposits, extending loans or advances insofar as the consideration is represented by way of interest or discount. What is that? Generally, there is no GST on interest income we discussed. It is exempted supply. But if you have any interest income, it is exempted for payment of GST. But while computing the ITC, you put it under taxable supply. But this point is not applicable to banking company, financial institution or NBFC. Except in case of banking company, financial institution or NBFC. Then next point. Services by way of transportation of goods by vessel. From where to where? From customs station of clearance in India to a place outside India. If there is any transportation of goods service by vessel from India to outside India, it is exempted here. Transportation of goods by vessel from India to outside India is exempted. Up to what period it is exempted? Up to 30th September 2020 it is exempted. And even though it is exempted for payment of GST, for availment of ITC it should be put under taxable supply. Now, so there are 7 exempted supplies and 2 points, even though exempted for payment of GST but should be treated as taxable for availment of ITC. Now, look into these scenarios here. Now, first point, export of goods against Indian rupees. Export of goods against Indian rupees is a 0 rated supply. But for the purpose of ITC, it should be treated as taxable supply. Export of service to Nepal and Bhutan against Indian rupees. To Nepal and Bhutan against Indian rupees, still it will become export of service 0 rated, but it should be treated as taxable for availment of ITC. Export of service to UK against Indian rupees. It is not a 0 rated supplier. Export of services to UK against Indian rupees, not a export of service. So it's a taxable supply for payment of GST. Even it is taxable for availment of ITC. Then interest income earned by bank. By bank it is exempted. For availment of ITC also it is exempted. What if the same interest income is earned by a trading concern? It is exempt for payment of GST, but for availment of ITC it is taxable. Then transportation of goods from India to outside India by vessel. Transportation of goods from India to outside India by vessel, exempted for payment of GST, but for ITC availment it should be treated as taxable. Transportation of goods by vessel from outside India to India is taxable for payment of GST, even for availment of ITC. See, if it is taxable for payment of GST, it will definitely be taxable for availment of ITC. No need to analyze there. Then what if it is transportation of goods by air from India to outside India? It is exempt supply for payment of GST. For availment of ITC also exempt supply. What about transportation of goods by air from outside India to India? That is exempt supply for payment of GST, even for availment of ITC. Then sale of land, sale of securities, sale of warehoused goods under customs. All these 3 are excluded from supply, not a supply. But sale of land should be treated as exempted supply. Even supply of security should be treated as exempted supply. Whereas sale of warehoused goods under customs, is it covered under exempted supply? No. So any other not a supply will not come under exempted supply. So this will give you a clarity about these 3 subsections. Now, we are moving on to manner of proportionate availment of ITC. That is, when I have some inward supplies which are partly used for taxable and partly used for exempted, partly for business purpose and partly for non-business purpose, I can take the ITC only that is attributable to, taxable supply, means proportionate ITC only I should take, or that is attributable to business purpose. How to take this proportionate? Generally, if you apply your common sense, what you will do? You will take credit multiplied by taxable supply divided by total supply. That much credit you will take. But the law has not given that way. They have given a different way. What is the different way? First take the credit. And that proportion related to exempted, you reverse. See, generally what we will do, we will take the credit proportionately to taxable we will take. Instead, now follow a different way. Take the entire credit, then reverse that proportionate related to exempted supply. Now, let's try to understand this. First, we need to take inward supplies, all inward supplies, ITC with respect to all inward supplies. ITC with respect to all inward supplies. ITC with respect to all inward supplies. I need to take that first. ITC with respect to all inward supplies I need to take first. Thereafter, I need to check whether it is in this matrix. What is this matrix? 4. Is it used for exclusively exempted? Is it used exclusively exempted? Is it used exclusively exempted? Then you cannot take ITC. Is it used exclusively non-business? Exclusively non-business. You cannot take ITC. Is it blocked credit? Is it blocked credit? Is it blocked credit? You cannot take ITC. Others. Others. You can take ITC. Others you can take ITC. Now, when it is coming in the 4th matrix, others you can take ITC. What is the meaning of others? What is the meaning of others? Which means I am using it exclusively for taxable and business purpose, or I may be using it both for taxable and exempted, both for business and non-business. I don't know. I could not classify in these 3 boxes, so I am putting it under others. Now, this others I need to further divide into 2. Exclusively for taxable and business. Exclusively taxable and business. Exclusively taxable and business. And second is common credit. Common credit means what? I could not classify it in any box. If it is exclusively for taxable and business, see, first I will take the ITC. For example, if the ITC with respect to all inward supplies is 1,50,000. 1,50,000. Out of this, 20,000 is exclusively for exempted. So I cannot take the ITC. And out of this, 10,000 is exclusively for non-business. I cannot take ITC. And some 15,000 is blocked credit. I cannot take ITC. Now what is the remaining? Out of 1,50,000, if we take out 20, 30, 45, then it will be 1,05,000. So can this 1,05,000 be taken as ITC? Yes. So this avail ITC. Avail ITC. Fully 1,05,000 you take ITC. Now thereafter I am doing the computation. What is that computation? How much is exclusively for taxable and business? Out of this 1,05,000, we have 80,000 exclusively for taxable and business, and remaining 25,000 is common credit. So this I have to identify. So invoice wise only I have to segregate and I need to identify. So what is a common credit? 25,000. Now in this common credit, can I take fully? No, I cannot take fully. Can I enjoy 80,000 fully? Yes, I can enjoy 80,000 fully. I don't have to do reversal. No reversal. No reversal. Don't take ITC. Already you took. Don't take it again. No reversal. That's it. With respect to this 25,000, can I fully enjoy? Whether should I reverse anything? Yes, I have to reverse. Now this 25,000 is segregated into 3. This 25,000 is segregated into 3. Attributable to exempted. Attributable to exempted. Attributable to exempted. Then attributable to exempted. One second. This is divided into 3. Attributable to exempted. Attributable to exempted. Then attributable to non-business. Attributable to non-business. Attributable to non-business. Balance. Out of this 25,000, how to know how much is attributable to non-business purpose or how much is attributable to exempted? Simple. 25,000 you take into exempted turnover divided by total turnover. Exempted turnover not mean 20,000. See, we have some exempted turnover. Say exempted turnover is 10 lakhs divided by total turnover is 20 lakhs. Exempted turnover is 10 lakhs and total turnover is 20 lakhs. So therefore 25,000 into 10 by 20, that is half, 12,500. Here exempted turnover is what? Exempted turnover is 10 lakhs and total turnover is 20 lakhs. So in that ratio attributable to exempted 12,500. This 12,500 what I should do? I need to reverse. This 12,500 I need to reverse. Attributable to non-business purpose. How to calculate? Suppose if there is any common credit attributable to non-business, very difficult to calculate. So I will be taking 25,000 into 5%, flat 5%. So that will be half of 2,500, 1,250. So balance, how much is balance? 25,000 minus 12,500 minus 1,250. So the balance, that will be 11,250. 11,250, no need to reverse. But this 12,500 and 1,050 we need to reverse, and here there is no reversal. So therefore, what is the total amount that I need to reverse? 12,500 plus 1,250, 13,750 rupees. I need to do the reversal. You understood or not? So now I am repeating it again. Have a look into it. I have some ITC with respect to all inward supplies 1,50,000. Out of this, exclusive used for exempted, I cannot take ITC. Exclusively for non-business, I cannot take ITC. Block the credit, I cannot take ITC. Remaining, I can take ITC. So first take ITC. Out of this, how much is exclusive for taxable and business we need to ascertain, and there is no need to reverse that. And remaining common credit. This common credit is again divided into 3. Attributable to exempted, I need to reverse. Attributable to non-business, I need to reverse. And balance, I don't have to reverse. So this illustration will give you a clarity. This only in law they have given it as a different way of presentation, but the concept is same, and this they denoted with some words. This is T. ITC with respect to all inward supplies is T. T1 exclusively for non-business. T2 exclusively for exempted. T3 block the credit. So first out of T we need to take out T1, T2, T3. And remaining is known as C1, credit that is taken to ledger, availment of credit. Now T4 exclusively for non-business purpose, exclusively for business purpose. Now common credit will be C2. How we will get C2? C2 equals to C1 minus T4. How we will get C1? C1 is nothing but T minus T1 minus T2 minus T3. Now we got C2 now. Out of this C2, what is attributable to exempted is denoted with D1. Attributable to non-business is denoted with D2. And balance will be called as C3. And D1 and D2 we need to reverse. So this is what C1 we will take credit and D1, D2 we will reverse. So this is the way of presentation given in law. Now whichever way it is comfortable for you, you can follow, but I have just given this example to understand the concept. Now look into that in the material, summary material, that's it. Rule 42 of CGST rules gives the manner of availment of ITC with respect to inputs and input services. There is total ITC on inputs and input services, and that is divided into 4, T1, T2, T3 and C1. So T1 exclusively for non-business, exclusively for exempted, block credit, remaining will be C1. Then in that C1, T4 we need to take out and balance will be common credit. Common credit D1 and D2, so we will get C3. This D1 and D2 are called as ineligible credits to be added to the output tax liability. Then next, C3 will be computed separately for ITC of CGST, SGST, UTGST and IGST. That is, everything should be computed separately. Then This particular computation, whether we need to do monthly or annually, we need to do it on a monthly basis. This computation we need to do on a monthly basis. Again, at the end of the financial year, for the total financial year, we need to do this computation and compare D1 and D2 computed on a monthly basis with total D1 and D2. So what is that we need to do? What is it we need to do? We have calculated D1 and D2 on a monthly basis. D1 and D2 we have calculated on a monthly basis. So I denote it with summation D1 and D2. This is monthly. This is monthly. Aggregate monthly. Aggregate monthly. This is aggregate monthly. This I need to compare with annual. This I need to compare with annual D1 and D2. This I need to compare with annual D1 and D2. If this monthly D1 and D2 is less than annual D1 and D2, what does it mean? We have reversed less. This is what we have actually reversed. Actually reversed. This is actually reversed. This is to be reversed. This is to be reversed. Now, what you have actually reversed is less than what you need to reverse, and therefore we need to reverse it further. We need to reverse it further. Suppose if it is greater than, then we have excess reversed, so we can take it as ITC. So this computation we need to do on a yearly basis, and we need to do reversal or take ITC by September of the succeeding financial year. See that summation D1 and D2 will be computed for the whole financial year by taking exempted turnover and aggregate turnover for the whole financial year. If this amount is more than the amount already added to output tax liability every month, the differential amount will be added to the output tax liability in any of the month till September of the succeeding financial year, along with interest at the rate of 18%. 18% interest to be calculated from when? From the 1st April of the succeeding financial year till the date of payment. Suppose if I have reversed the excess, if this amount is less than the amount added to output tax liability every month, the additional amount can be taken as ITC. Sir, will they give any interest? No, they will not give any interest. And this ITC to be taken by September of the succeeding financial year. So if you want to save interest, when you need to do this computation? By end of the financial year. By March, you need to do this computation. So this is with respect to Rule 42. Then Rule 43 is manner of availment of ITC in case of capital goods. What is that is given? We have to divide capital goods into 3. See, Rule 42 is manner of availment of ITC in case of inputs and input services. Whereas Rule 43 is manner of availment of ITC in case of capital goods. Capital goods are divided into 3 categories. Category 1, which is exclusively used for taxable. Can we take ITC? No. Category 2, it is used for both taxable and exempted. Can we take ITC? Yes, you take full ITC. Which is used exclusively for exempted. Can we take ITC? No, you cannot take ITC. Now, with respect to capital goods 1 and capital goods 3, very simple. Exclusively used for taxable. Enjoy the ITC. No need to do any reversal. Capital goods 3, exclusively used for exempted. Don't take ITC. With respect to capital goods 2, you take the ITC and you need to do reversal on a monthly basis. That I have given below. What is that reversal on a monthly basis? First, take 100% of ITC with respect to GST paid and transfer it to the electronic credit ledger. First, take the credit. That is step 1. Step 2. You need to calculate the monthly ITC. How to calculate monthly ITC? Total ITC divided by 60 months. Let's see this with an example here. Say 10 lakhs is the price of the capital goods. 10 lakhs is the price of the capital goods, and on that GST is 1,20,000. GST is 1,20,000. So step 1, take this 1,20,000 as ITC. Step 2, what is the monthly ITC? What is the monthly ITC? Monthly ITC is 1,20,000 divided by 60 months. Why 60 months? Because we need to have a deeming life here. irrespective of the actual life of the asset, capital goods, we need to take the life of the capital goods as 5 years, that is 60 months. So 1,20,000 divided by 60. So the monthly ITC will come to 2,000 rupees. Now, how much you can take as ITC? 1,20,000 you take, but when you are doing reversal, calculate the monthly ITC. That monthly ITC into exempted supply during a month divided by total supply of that month, you need to reverse, add it to the liability. For the next 60 months from the date of purchase, compute monthly ITC attributable to exempted supply, that is monthly ITC into exempted divided by total. For example, in a month, if in a month half is exempted and half is taxable, means out of this 2,000, 1,000 can be taken as credit and 1,000 needs to be reversed. So already you took 1,20,000, so that you take. Now reversal, how much? 1,000 you need to reverse along with interest. See the point number 4. The above amount to be added to the output tax liability for every month for next 60 months along with interest at the rate of 18% per annum. From when to when? From the date of availment till the date of addition to output tax liability. Means for 60th month we need to calculate 60 months interest here. So that is the problem here. Then the above procedure is not required in a month when CG2 becomes CG1. When CG2 becomes CG1, not required because exclusively it is used for taxable, so no need to reverse anything. Or the capital goods are sold. You sold the capital goods, then also you don't have to do this reversal. Then, with this we completed Rule 42 and 43, manner of availment of ITC in case of inputs, input services and capital goods. That is there. Okay. Now, we have one special point here. That is, initially at the time of purchase, I have used it as CG1. But later on, I converted it into CG2. Or initially at the time of purchase, I have used it as CG3. Later on, I converted into CG2. Suppose if any conversion take place, what is that? CG1 to CG2 or CG3 to CG2. If there is any conversion that takes place, then we need to reduce 5% for every quarter or part thereof for the period for which you have used it as CG1 or CG3, and thereafter it will become common credit. For example, on 1/4/2019, you purchase this capital goods worth rupees 10 lakhs by paying GST 1,20,000. Now, thereafter, next financial year, say by 20 June 2020, by 20 June 2020, you converted into CG2. What is the period for which it is used as CG1? For every quarter or part thereof, even part of the quarter should be taken. So one full year, 4 quarters, plus next year, April, May, June, 1 quarter. So total 5 quarters. So 5 into 5, 25%. So therefore, what will be the common credit? The common credit will be 1,25,000 minus 25%. That will become common credit. And that common credit, again, you need to do monthly computation for the next 60 months. Let's see an illustration related to this capital goods point, which is given in questions for practice by ICAI. Have a look into question number 2. XYZ Private Limited is a manufacturing company registered under GST in the state of Uttar Pradesh. It manufactures 2 taxable products, alpha and beta, and 1 exempted product, gamma. On 1st October, while product beta got exempted through an exemption notification, exemption available on gamma got withdrawn on the same date. The turnover exclusive of taxes of alpha, beta and gamma in the month of October was 9 lakhs, 10 lakhs and 6 lakhs. So what is that is given in the first paragraph? There is a company which is into manufacturing and they are registered in the state of Uttar Pradesh. They manufacture 2 taxable products, alpha and beta, and 1 exempted product called as gamma. On 1st October, while a product beta got exempted through an exemption notification, exemption on gamma got withdrawn. So initially, out of alpha, beta and gamma, initially alpha, beta and gamma, initially is what? It is taxable, exempted. This is what initial. And later what has happened? Alpha is taxable only, but the beta became exempted and gamma became taxable. So this is given in first paragraph. And what is the turnover of alpha, beta and gamma for the month of October? See, this is like October. This is for October month. And I have given the turnover of alpha, beta and gamma. XYZ Private Limited has furnished the following details. Machinery U purchased on 110 for being used in manufacture of all the three products. On which date you purchased? October. For all the three products. It is not exclusively used for taxable or exclusive for exempted. So this will become common credit. Machinery V purchased on 110-2000 for being used in manufacturing product alpha and gamma. Now alpha and gamma for October month it is taxable, therefore it is not common credit. So entire ITC available. Whether any reversal to be done? No, reversal is not required to be done. Machinery W purchased on 110-2000 for being exclusive in manufacturing product beta, exempted. So it's an exempted product. You cannot take ITC. No ITC. Machinery X purchased on October 1, 3 years before 110-2000. So 3 years before this date, they purchased machinery X. Being exclusively used in manufacturing product gamma. At the time gamma was what? Exempted. So no ITC would have been taken at the time when it is purchased. Now 3 years is over. Now from 110-2000 such product machinery will also be used for manufacturing beta. Initially it was used only for gamma, means CG3. Now it is used for gamma also. Now it is used for both taxable and exempted. See, initially it was used only for gamma, exempted. Now it is used for both beta and gamma. So used for both taxable and exempted. So this will also become common credit. But how much will be the common credit? So you cannot take 90,000. You need to reduce 5% for every quarter or part thereof. When you purchase October, means October of the 3 years before. So for 3 years, how many quarters? 12 quarters. So 12 into 5, 60% you need to reduce here. And remaining 40% only you can take. Minus 60%. So remaining 40% can be taken as common credit. And should we take it now? Yes, because at the time when it was purchased, it was used only for what purpose? Exempted. But now it is used for both taxable and exempted. So at that time it would not have been taken. Now you need to take this common credit. Common credit to be availed. 90,000 minus 60%. Then up to this we will see in the answer. Up to machinery D. So machinery A 36,000. Can we take ITC? Yes, we can take ITC, but it is a common credit. Machinery V 18,000 full credit we can take. Then machinery W no ITC. Machinery X we can take ITC after reducing 60%. So 90,000 minus 60%, 36,000. Okay, look into note 1, 2, 3, 4. Note 1. ITC with respect to capital goods used commonly for affecting taxable and exempted supply can be taken to the ledger. ITC in respect of capital goods used exclusively for exempting exclusively for extending supplies other than exempted can be taken as ITC. Note 3. ITC in respect of capital goods used or intended to be used exclusively for exempted supplies cannot be taken as ITC. Note 4. What we need to do? We need to take 90,000 minus 60%. How 60%? 5% into 12 quarters. So 36,000 is taken as ITC. You understood these notes you need to write. And here, what are the common ITCs so far that we have discussed? So common ITC is 36,000 and this 36,000. 90,000 minus 60%. Now, look into machinery Y. Purchased on October 1, 4 years before 110 for being used exclusively in manufacturing product beta. At that time it was what? Only taxable. So you would have taken the ITC already with respect to machinery Y. From 110-2000 such machinery will also be used for product gamma. Means now it will become common. Whether we need to take ITC? No need to take ITC because it is already taken. It is a common credit for computation. No need to take the ITC because ITC is already taken. So now again you don't have to take the ITC. It is only for computation we are determining 4 years before. So which means how many quarters? 4 into 4, 16 quarters. So 16 into 5, 80% you need to reduce. So balance 20% you can take as common credit, but no need to avail the common credit. It's for computation. So you look into that. We have not taken anything now because already it has been taken, but for computation we are doing that. Then next, machinery Z purchased on October 1, 2 years before 110 for being used in manufacture of all the 3 products. It's a common credit. So fully you can take the credit. Common credit, fully you can take 54,000, we can take the credit. Is it? Machinery Z, one second. Machinery Z purchased on October 1, 2 years before for being used in all 3 products. It was common credit. It was common credit at that time. So at that time itself they would have taken the credit. So now no need to take credit this month. Already it was taken, but it is a common credit for computation. Common credit for computation. Then raw material used for manufacturing alpha purchased on 510. Alpha 510. It is alpha is taxable no. So we can take ITC. Avail ITC. Avail ITC 27,000. So that is there. Then raw material used for manufacturing beta purchased on 1010. 36,000 exclusively for exempted. Don't avail ITC. Don't avail ITC. So with respect to 36,000, we have not taken any ITC. Then next, raw material used for manufacturing gamma. Gamma is not taxable. So we can take ITC, avail ITC. So therefore 18,000. So this much is the ITC that we can take for this October month. Now what is the common ITC? Calculate common ITC. First, common ITC, 36,000 is common ITC. Then again another 36,000 is common ITC. Then 72,000 minus 80%. 36,000. Then this 4 years before purchase 80%. 14,400. 86,400 becomes common credit this month. So 86,400 becomes common credit this month onwards for next 60 months. Common credit already it was common credit. Now we are just taking it for computation. What is that? 2. That is for computation purposes we took na. That is, so what are the 3 common credits? The 3 common credits are this 36,000. That is which become common credit this month. So 36,000 plus 36,000 and 72,000 minus 80%. That is 20% of 72,000. 72,000 into 20%. 14,400. These 3 will become common credit this month. Whereas this 54,000 already became common credit. So now it is not for this month. Already it became common credit. But this month we will take. So 54,000 also should be taken. Now see this. These 3 common credits 86,400 divided by 60,440. Then this 54,000 was there. Na? 54,000. This 54,000 divided by 60, which was used for manufacturing all 3 products. So 54,000, and that 54,000, look into note 11. 54,000 divided by 60, 900 plus 1,440, 2,340. So this 2,340. How we got this 2,340? 1,440 plus this 54,000 is also there. That is also common credit for computation. So 54,000 divided by 60, that is 900. So total 2,340. Now this 2,340 multiplied by exempted supply divided by total supply of this month. For this month they have given turnover. Now what is the turnover for this month? Exempted is what? Beta. Beta is exempted. So 10 lakhs divided by 9 lakhs plus 6 lakhs plus 10 lakhs. So that ratio we need to calculate. 10 lakhs divided by 25 lakhs. So 936 rupees needs to be reversed. Now, what is the GST liability? So they have given some outward supply, I think. Compute the amount of ITC, common credit. Common credit attributable to exempted supply. GST liability of the company payable through electronic cash ledger. Now see that. So 9 lakhs 18%, 1,62,000. Beta is exempted. Gamma, we need to pay GST payable. Common credit attributable to exempted supply, this is 936, we need to add. Total output tax liability less ITC available and IGST. They have not given interest computation in this question. If there is any interest computation, even that should also be taken. Okay, so this is about this question number 2, and it's a very important question, and you can expect this type of question in exam. Now, we will look into question number 1, which is related to blocked credits. Have a look into that. With reference to the provisions of Section 17 of CGST Act, examine the availability of input tax credit under CGST Act in the following independent cases. MBF Limited, an automobile company, has availed works contract service for construction of foundation on which machinery to be mounted permanently. Works contract service is a blocked credit, but when it is in relation to plant and machinery, we can take ITC. So therefore, ITC is available in this case. Then second, Shah and Constructions procured cement, paint, iron rods and services of architects and interior designers for construction of a commercial complex for one of its clients. See, for construction of one of its clients means it's not for their purpose. They are rendering services. Can they take ITC? Yes, because we discussed that construction service, any goods used for construction and works contract service has block credit only in relation to a recipient, not to supplier. Therefore, in case of second point also, ITC is available. ITC is available in this case. Then, ABC Limited availed maintenance and repair services from Jaggi Motors for a truck used in transportation of finished goods. Is truck eligible for ITC? Yes, it is not a blocked credit. Therefore, truck is eligible for ITC. When truck is eligible for ITC, the repair and maintenance service in relation to the truck is also eligible for ITC. Therefore, ITC is available. So, this is a first question related to the blocked credits. Look into question number 5, that is related to Rule 42. We discussed one question on block credits, one question on Rule 43, now another question on Rule 42. All-in-one store is a chain of departmental store having presence in almost all metro cities across India. Both exempted as well as taxable goods are sold in such stores. The stores operated in rented properties. All-in-one stores pays GST under regular scheme. In Mumbai, the store operates in a rented complex, a part of which is used by the owner of the store for personal residential purpose. All-in-one store Mumbai furnishes following details for the month of October. Aggregate value of various items sold in the store: taxable items 42 lakhs, items exempted via a notification 12 lakhs, items not leviable to GST 3 lakhs. Mumbai store transfers to another all-in-one store located in Goa certain taxable items for the purpose of distributing the same as free samples. The value declared in invoice for such items is 5 lakhs. Such items are sold in Mumbai store at 8 lakhs. So up to this we will try to understand the question. First, there is a store, departmental store, which is having presence in across the country. They are dealing with both exempted as well as taxable supplies. They are dealing with both exempted as well as taxable supplies, and they operate in rented premises, and they are opting for regular scheme, so they are not into composition scheme. And in Mumbai, the store operates in a rented complex, a part of which is used by owner for personal residential purpose also. So part of the inward supply is used for taxable, exempted, and then non-business also is there. All-in-one store Mumbai furnishes following details for the month of October. Their outward supply details are given. One store outward supply, Mumbai store outward supply. Taxable items 42 lakhs, exempted items 12 lakhs, not at all leviable to GST, that 3 lakhs. That store transfers to another store. Distinct person transaction between another distinct persons chargeable to GST for the purpose of distributing the same as free gifts. So that another store will be distributing it as free gifts. The value declared in the invoice for such item is 5 lakhs. Such items are sold in the Mumbai store at 8 lakhs. Now, is recipient eligible for full ITC with respect to this inward supply? Transaction between distinct person. How to determine the value in case of transaction between distinct person, related person or distinct person? We need to take open market value. If recipient is eligible for full ITC, the transaction value is deemed as open market value. But here the transaction value cannot be deemed as open market value, because what the other distinct person is going to do, that another store is going to distribute it as free gifts or sample, means ITC is not available. In that case, open market value should be taken. So what should be taken as a value in this case? 8 lakh should be taken as value in this case. Aggregate value of various items procured for being sold in the store. This is purchase details. Taxable items exempted under notification, not leviable to GST. Purchase details given. Freight paid to GTA for inward supply of transportation of taxable items 1 lakh. Freight paid to GTA for inward transportation of exempted items 80,000. With respect to fourth point, inward supply, we can take ITC because that is used exclusively for taxable. Fifth point, GST paid cannot be taken as ITC because it is used for exempted. Freight paid to GTA for inward transportation of non-taxable items, ITC cannot be availed. Monthly rent payable for the complex is 5,50,000. 1/3 is used for personal purpose. So 1/3 is for non-business purpose. Activity of packing the items and putting the label of the store along with the sale price has been outsourced. Amount paid for packing of all the items is 2,50,000. Salary paid to the regular staff at the store is 2 lakhs. So on that GST is not paid. It is employer-employee relationship. So GST is not paid. GST paid on inputs used for personal purpose, ITC not available. GST paid on rent-a-cab service availed for business purpose. So they are a manufacturer. If they purchase a car, can they take ITC? No. So if they take their car on rent also, they cannot take ITC. It's a blocked credit. GST paid on items given as free samples, ITC not available. Given the above available facts, you are required to compute the following. Input tax credit credited to electronic credit ledger, common credit, ITC attributable towards exempted supply out of common credit, eligible ITC out of common credit, net GST liability. This is purely related to rule 42. We will stick to the format. What is the format? T minus T1 minus T2. That format is there now. That format we will stick so that we will arrive at the answer. Wherever applicable, GST under RCM is payable at the rate of 5%, which means that on GTA services, GST is paid under RCM. Then, all the sales and purchase made by the store are within Maharashtra. All the purchases are made from registered suppliers. All other expenses incurred are also within the state. Wherever applicable, the amounts given are exclusive of taxes. All the necessary conditions for availing ITC have been complied with. Now, first we will calculate ITC that is taken, and then common ITC, reversal, everything we need to calculate. So rule 42 we will take. First identify the total inward supply. T I need. So what is the T? Total inward supplies. First 55 lakhs GST would have been paid. Items exempted by notification, aggregate value of various items procured for being sold in the store. Taxable items 55 lakhs. So on that 55 lakhs, what is the rate of GST? 18%. So now 55 lakhs into 18%, 9,90,000. Then next purchase. 15 lakhs, it is exempted. So no need to pay any GST. Then 5 lakhs exempt, non-taxable or not chargeable to GST, no need to pay GST. So on 15 lakhs and 5 lakhs, there is no GST paid. Then next, with respect to GTA services, GST is paid under RCM. So 1 lakh, GST is paid under RCM 5%. So 1 lakh into 5%. Even this 80,000 and even this 20,000. So on entire 1 lakh, 80,000, 20,000, GST is paid under RCM 5,000, 4,000, 1,000. Next, monthly rent payable for the complex 5,50,000. 5,50,000 into what is the rate of GST? 18%. Why 5,50,000 into 18%? It is used for residential purpose. Even though it is used for residential purpose, partly for commercial, partly for residential purpose, we need to pay. So monthly rent 5,50,000 into 18%. Then packing charges they have outsourced 2,50,000. 2,50,000 into what is the general rate? 18%. 2,50,000 into 18%. Salary paid to the staff will not come. Employer-employee relationship, so that will not come. Then GST paid on inputs used for personal purpose. GST is paid, so 5,000 into 18%. Okay, 5,000 itself is the GST paid, so fully you take. GST paid on rent-a-cab services 4,000. Even GST paid on items given as free sample 4,000. This is the total ITC. 11,57,000 is the total ITC. Step 1. Then T1, T2, T3. Out of this, which is exclusively for non-business purpose. Monthly rent 1/3 is non-business purpose. So what is a monthly rent? GST 99,000. 99,000 into 1/3, 33,000 is for non-business purpose. So therefore that is T1. Then anything used for personal purpose? Yes. GST paid on inputs used for personal purpose 5,000, 38,000. It is T1. T2 is what? Exclusively for exempted supplies. Now, inward supply of GTA services, which is exclusively used for exempted, 4,000. So that 4,000 will come. Then GTA with respect to non-taxable 1,000. So that will come under T2. Then blocked credit. What is blocked credit? Rent-a-cab service is a blocked credit. So 4,000 rent-a-cab services. Then items given as free gifts or samples also blocked credit 4,000. So total 8,000 is there. So T1, T2, T3. What is T1? 38,000. T2 5,000. T3 8,000. So if you take out, the remaining credit will be taken to the ledger. T minus T1, T2, T3. Now what is the common credit? Out of this 11,06,000, we need to take out which is exclusively for taxable. GST paid on taxable items. First one, first GST paid on taxable item 9,90,000. We can fully take this. For inward supply of taxable items, this 5,000 also fully we can take. So say this 9,90,000 plus 5,000, 9,95,000 fully we can take, and remaining are common credit. Why common credit? This we have not taken credit, this we have not taken. Monthly rent is a common credit because it is used for all. Then 45,000 is also common credit used for all. So therefore, what is the common credit? Remaining part. So remaining will be called as the common credit, and that common credit attributable to 1,11,000. How we got this 1,11,000? See here, 99,000 plus 45,000. Monthly rent 1/3 we have taken, so 2/3 should be taken. 99,000 into 2/3 and 45,000. So that will be 1,11,000. This 1,11,000 attributable to exempted supply E by F. So we need to take the exempted supply turnover divided by total turnover. So E by F, we will be getting this. So that is D1 to be reversed. Same way for non-business purpose. Non-business purpose, anything is there that should be taken, but we don't have anything for non-business purpose. So therefore 25,615 needs to be reversed. So remaining ITC we can take. That is this. GST liability we need to compute. Forward charge, reverse charge first we need to pay. Reverse charge we need to pay. Always we need to pay. But whatever we pay under reverse charge, that can be taken as credit. See here. So whatever we pay GST under reverse charge, ITC we can adjust it for payment of GST under forward charge. Now reverse charge we need to pay and ITC cannot be adjusted. So that's the net GST liability. So this question is related to rule 42. So you can go through this. This is second alternative presentation, but you don't have to follow this second alternative presentation. You follow the first one itself. Whatever we have discussed, the T1, T2, that presentation itself is okay. And the second alternative presentation is there. So that alternative presentation is not required. Okay. So you can go through this question at your end. I have just given you the guidance as to how to arrive at the answer for this question. So with this, we completed 17 subsection 1, 2, 3 read with rule 42 and rule 43 along with the illustrations related to that. And in the next video, we will proceed to 17 subsection 4 and then section 18 input tax credit in special cases. Thank you.